Welcome to Core Finance, where I'm joined by David Harris, who's CEO at the Invatrust Consultancy. How are you today, David?
I'm very well, Zach. Thanks very much.
Okay, you're going to give us a happy Christmas message, just a bit like Her Majesty the Queen, about how to avoid common investment mistakes.
Well, I hope not too many people are watching this at 3 o'clock on Christmas Day.
But I'm sure they will still be watching it at that time. But we were just discussing offline. This applies, I suppose, from everyone from Anthony Bolton and Neil Woodford down to you and me, doesn't it?
Yes, trying to avoid common investment mistakes. When you've got situations such as we have here in the UK at the moment and in Europe with, I hate to say the word Brexit, but you have to, then you've got Donald Trump and China taking bits out of one another. It makes markets nervous. There are still individuals like you and I, and there are professional investment managers who have money to put somewhere. And what are the mistakes that you need to try to avoid? The first one on my list was not doing proper research. There's a wealth of information out there, company websites, reporting accounts, even newspapers, although be careful a little bit with newspapers because it does tend to be yesterday's news that they're reporting, and that could very easily already be in the price. But do read up. Do you understand, for instance, what business the company you're looking at is actually in? We have this broad definition these days, say, of technology, but within the technology sector, there is a wealth of different sectors. So you've got to try to understand as well as you can the investment you're trying to make.
Right, and to get to the sporting analogy, which we were discussing before, I mean, let's say you're on the tennis court, you could be looking at the audience, you could be looking at the other player at the other side of the net, but really you should be looking at the ball, and only the ball. And so in the case of companies, are you going to be looking at the accounts, are you going to be looking at their news flow, the management? I mean, it'll be down to that type of focus?
Yes, I mean, you've got to be focused, and you've got to try to encompass everything that you've mentioned there. Now let's be realistic. There's a time factor involved in this as well. And that's why most people, I think, sub out a lot of their investment decisions to people like Neil Woodford to try to get on with their own day whilst leaving the investment side of life to somebody who theoretically is going to do a better job than them.
And how do we assume that we can do the same or hopefully better than the professionals?
Well, you've all got the same basic tools to work with. They're having to look at all of that information. They're having to assess the risk that's involved with a particular investment. Now risk, that's a small word, but it underlines everything that investment is about. And risk, I believe, is about uncertainty, the uncertainty of the return that you're going to make, the uncertainty of the world that the company that you're about to invest in is operating in. Something out of left field may well come in. Something may happen in the Far East tomorrow morning, which majorly affects your company. So you've got to be alert to all of these things, and that's why doing your research, we keep going back to this, doing your research and redoing your research on a regular basis, I think is very important.
Right, and of course one of the the cliches in the market: buy low, sell high.
Yeah.
Would that work? Does that still work?
Well, in my opinion, no. I mean, just avoid trying to time the market. We would all like to buy low, sell high. We would all like to be in the market when it's moving upwards and not in the market when it's moving downwards. That's perfection. Perfection isn't achieved either by the professionals or by you and I doing our own. You have to decide that you want to invest in a particular company, in a particular fund, in a particular trust, in a particular pension fund. Do your research, decide that's where you want to invest, put your money in there, review it on a regular basis, and don't be afraid to sell, and don't be afraid to buy more. If, for instance, the price were to fall a little, if you still believe in that company, then there is every reason to suggest that maybe it's right to average down the purchase price that you're paying and to look further into the future.
Right. Well, I'm going to perhaps be a bit unfair, but let's say there are two situations that I can remember or come to mind in the recent past. One was Fever Tree, which just kept on going up and up and up,
Yes.
and you could bought it at £2, £3, £10, £20. That was
Yes.
one of the phenomenons and phenomena of the market. That's a momentum play, let's say.
Yes.
And then the other situation, which is going on at the moment, Thomas Cook,
Yeah.
where you've got great name that everybody in the country knows. You're catching a falling knife. Which way would you go? Or just avoid both of them? I mean, is it
Well, now look, if you'd have asked pretty much anybody, say 10 years ago, whether or not anybody was going to outdo Schweppes in the tonic water stakes, you'd have probably said, no, I can't see why. I mean, tonic water is tonic water. Somehow or other, Fever Tree have produced something that's convinced the likes of our other halves that what needs to go in their gin is Fever Tree tonic because it tastes entirely different to Schweppes tonic. Now, whether you believe that or don't believe it, as you say, it's a momentum play. They've done very well. Would you buy more of it at the price it's at now? Probably not, because the likelihood is that the next best thing since sliced bread in the tonic market it will come along, and that will have a detrimental effect. Thomas Cook, well, now everybody likes to go on holiday, and so why is it that people don't want to go on holiday with Thomas Cook at the moment? They've been a little bit unlucky, I think, with some of the publicity. There was an event in Egypt, I think it was, where a couple unfortunately died through, I think it was carbon monoxide poisoning or something. Now, effectively, the person you've booked the holiday through, I think it's a bit savage to blame them for these events, but it does put a stain on the reputation of the company. And once that starts to happen, people go elsewhere, and the company share price drops, and they will have to do a lot of battling to get back into people's favour.
So isn't the answer with those two? I mean, those are classic examples of things to avoid, because
Yes.
we don't. There's so many variables there. We don't know. It's too complicated. Avoid it. So go for something simple.
Yeah, well, that's what I was saying with, do you understand what you're investing in? Have you done your research? Those are two very, very difficult ones to understand. If you'd have been lucky enough to get into Fever Tree right at the outset, you're smiling all the way to the bank. If you were unlucky enough to be in Thomas Cook before the fall began and you've done nothing about it, then, as you say, they're very difficult ones. And I go back to my saying of, we have these professional fund managers, and often it is easier for the likes of you and I to allow them the luxury of making those decisions on our behalf.
But isn't their main weapon, apart from hopefully being cleverer than you and I, that they are diversified? They do actually, they tend to go by a certain set of rules. They have, I don't know, at least 12 stocks in their portfolio. They are diversified across different sectors, different geographies, and so they actually do things. It's boring, but that's what they do. They'll have 12 different sectors, 12 different stocks, different parts around the world. They're not going to double and triple, but they're not going to halve and do worse and do worse. So that's what you're relying on, really. Diversification.
Diversification, and we've talked about it many, many times on this channel and elsewhere, that you can't just look at the UK. I mean, the UK is a minute part of world markets these days. Interestingly, if you look, of course, at our FTSE 100, its 100 biggest companies are actually very big international companies with a huge amount of their earnings actually coming through in different currencies other than pound sterling. So that diversification actually perhaps is already there if you were to invest, say, into an exchange-traded fund that replicates the FTSE 100 index. But again, going back to our professional fund managers, yes, you're absolutely right. They do this day in, day out. It's not a new concept. I mean, I can remember when I was first starting, somebody invented something called a managed fund, which essentially at that time was a little bit of property, a little bit of equity, a little bit of fixed interest, and a little bit of cash. And you put the lot together, and no one sector tends to go up and down in tandem. They all vary, and through the course of it, you should get a steady gain.
So the answer here is basically not so much avoiding mistakes, but making sure that you're covered, or you think you're covered, in various scenarios.
Yeah, I mean, there's a great deal of evidence to suggest that you will do more damage to yourself by being out of the market at the wrong time than being in the market at the wrong time. Now, we could get extraordinarily complicated about that, but it's probably easiest to suggest to you that we go back to this market timing. Don't try to time the market. Make your decision that you need to invest. Put some money in, review it carefully and review it often, but be in the market pretty much all the time. You will do yourself damage if you try to sell a market time.
Okay, we'll see how that goes for 2019. In the meantime, David Harris, CEO at the Invatrust Consultancy, thank you very much indeed.
Thanks, Zach.